Everyone is popping champagne over South Korea's record-breaking January exports. But here's the number nobody is mentioning. Despite a staggering 70% surge in semiconductor shipments, Korea actually recorded a $600 million trade deficit in the first 20 days of 2026. The AI supercycle is finally here, but the broader economy is bleeding out.
600 million in the red while your biggest export is up 70%? That is a brutal reality check. And welcome back to Asia Tech Macro. I'm Maya, looking at the world from the founder's seat, where cash flow is the only truth. And with me is Alex, who spent a decade at a hedge fund and still believes that growth is just a statistical error we haven't corrected yet.
I prefer the term skeptical pragmatist, Maya. But seriously, let's look at the data from the Korea Customs Service released on January 21st. The headline number is impressive. Total exports jumped nearly 15%. But if you strip out the semi-component, which surged 70.2% year-on-year, the rest of the economy looks flat. Chips now account for almost 30% of Korea's total export value. We are dangerously close to becoming a monoculture economy.
It's basically Samsung and friends carrying the entire GDP on their backs. I saw a note from Kim Jin-wook at Citi this morning. He's predicting semiconductor export growth could hit 70% for the full year of 2026. That's compared to just 22% last year. The demand for HBM, high bandwidth memory, is insatiable. But Alex, devil's advocate here. If they're selling so much, why the deficit? Where's the money going?
That's the catch. They are caught in a CAPEX trap. While exports are up, imports of semiconductor manufacturing equipment rose over 42% in the same period. They are selling the chips, but they have to buy the expensive machines from ASML and Applied Materials to make them. It's a cash-intensive cycle. Plus, energy imports fell by 12.5%, so they can't even blame oil prices this time.
That reminds me of the 2017 supercycle, but worse. Back then, at least the domestic economy in Seoul was buzzing. Now, I read that private consumption only grew 1.3% last year. The wealth isn't trickling down to the streets of Gangnam, it's staying locked in the industrial parks of Yongin.
Exactly. And there is a geopolitical angle that Washington won't like. Exports to China surged 30.2% in early January. While the U.S. talks about de-risking, Korea's recovery is being fueled by a massive rebound in Chinese demand for legacy and mid-tier chips. It's the China plus one paradox. Companies are moving factories to Vietnam, but they are still buying the brains from Seoul and shipping them to Shanghai.
So Korea is technically booming, but practically broke. That is a tough narrative for the central bank to manage. But speaking of tough narratives, let's pivot to Japan. They are making a move that I honestly didn't think I'd see in my lifetime. They are effectively ending their digital pacifism.
You mean the active cyber defense strategy? This is huge.
Precisely. For decades, Japan's cyber strategy was essentially build a thicker wall and hope for the best. But as of late January 2026, the new national security strategy has flipped the script. They are moving from passive defense to active defense.
Active defense is a polite diplomatic term for "we will hack you back." I was looking at the leaked budget draft from the Cabinet Office around January 24th. They are earmarking nearly 1 trillion yen specifically for cyber deterrence capabilities. This gives the government the legal authority to penetrate and neutralize attacking servers, even if those servers are technically domestic zombies being controlled from abroad.
That is the controversial part, neutralizing domestic servers. As a former tech founder, that phrase makes me nervous. I saw a heated debate on Nikkei Asia yesterday quoting Hiroshi Miyazawa from the Japan Association of Corporate Executives. He said that while Japanese companies are desperate for protection against ransomware, they are terrified of what he calls the backdoor mandate.
It's the classic liberty versus security trade-off. But look at the market reaction, Maya. The investors have already voted. Shares in Japanese cybersecurity firms like FFRI Security and Trend Micro have jumped over 15% since the announcement. The market realizes that Japan has been a soft target for too long. If you want to integrate with the U.S. defense grid, which is the whole point of this 2026 alliance upgrade, you can't have your critical infrastructure running on legacy software with no offensive capability.
True, it's a forced modernization. But Alex, does this actually work, or are we just creating a digital arms race in East Asia?
We are absolutely creating an arms race, but the alternative is to be a sitting duck. I saw a report from a defense analyst at Nomura saying that by 2026, every major Japanese utility and bank will be required to have government-certified cyber monitoring. That is basically a license to print money for the domestic security integrators.
So the digital pacifist is dead and the digital warrior is open for business. That is a massive shift in the region's risk profile. But while Japan is spending billions to harden its defenses, something else happened last week that proved you don't need billions to win the AI war.
You're talking about the DeepSeek moment.
Exactly. The GPU efficiency shock. Everyone has been obsessed with hoarding H100s and building $10 billion clusters. Then out of nowhere, the DeepSeek V3 benchmarks dropped, and it turns out they matched GPT-4 level performance with a fraction of the training cost and significantly fewer GPUs.
It's the Moneyball moment for AI. I saw a technical breakdown from a researcher at NUS yesterday. He pointed out that by using mixture of experts architectures and aggressive optimization, the inference cost, the cost to actually run the AI, dropped by nearly 90% compared to the standard models we were using in 2025.
90% cheaper? That completely changes the unit economics for startups in Asia. If I'm a founder in Jakarta or Bangalore, I don't need to raise $100 million for compute anymore. I can run a world-class model on a lean cluster. This democratizes the field overnight.
It does, but it's bad news for the hardware bulls. I saw a very bearish note from a CLSA analyst suggesting that the efficiency gap is closing so fast that the demand for raw GPU power might peak earlier than anyone expected. If you can do more with less code, why buy more chips?
That is a brutal take for Nvidia shareholders, Alex, but it makes sense. It reminds me of the cloud wars in 2015. At first, it was about who had the most servers. Then it became about who had the most efficient code. We are entering the optimization era.
Exactly. And that leads us perfectly to our contrarian corner.
All right, Alex, give it to us. What is the consensus truth that you are ready to dismantle today?
The consensus is that data is the new oil. We've heard it ad nauseum for a decade. Every company, from banks to grocery stores, is hoarding petabytes of data, thinking it's their most valuable asset for the AI age.
And you think it's not?
In 2026, I think big data is actually a toxic asset.
A toxic asset? Explain.
Think about it. Between Japan's new active defense laws effectively opening up networks and the efficiency revolution we just discussed, having massive, messy lakes of data is a liability. It makes you a prime target for state-sponsored hackers, and it drags down your AI's efficiency. The contrarian move for 2026 is small data, high density. The winners won't be the companies with the most data, but the ones with the cleanest data that requires the least amount of energy to process and secure.
So digital minimalists will outperform digital hoarders? That is going to be a tough pill for the storage industry to swallow. But looking at the cybersecurity risks we just talked about, I can see the logic. Less surface area, less risk, faster AI.
Precisely. The market pays for margins, not for storage fees. Now, let's wrap this up with the action items. What should our listeners actually do on Monday morning? Action item 1, rebalance your Japan portfolio. The active cyber defense law is a multi-year tailwind. Stop just buying the trading houses, Sogo Shosha, and start looking for the digital shield players, the domestic cybersecurity firms that are getting the government contracts to monitor critical infrastructure. They have a guaranteed revenue stream for the next 5 years.
Action item 2. If you are an angel investor or VC looking at AI startups in Asia, stop asking about their training scale. Start asking about their inference efficiency. The firms that can run GPT-5 level logic on a local edge server are the ones that will survive the post-GPU bubble world. The era of brute force fundraising is over.
And action item 3. Watch the Korean trade numbers due on February 15th. If the trade deficit doesn't narrow despite that 70% chip surge, it's a sign that the AI boom is completely decoupled from the real economy. Be very careful with the Korean won or KRW if that happens. It could weaken even as the stock market rallies.
Great stuff today, Alex. We went from cyber swords in Tokyo to the efficiency shock in the AI labs.
It's going to be a volatile year. Data is the only hedge. Next week, we're looking at the inbound tsunami in Japan and why 140 yen might be the new permanent floor for the currency.
I'll bring the data, you bring the skepticism.
Deal. Thanks for listening to Asia Tech Macro. Don't forget to subscribe on Spotify or Apple Podcasts and leave us a review.
Stay data-driven. See you next week.
Bye.
Bye.